Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial. In this latest edition of the Street View, I'll share some charts we recently highlighted on our blog. George Smith, our portfolio strategist here at LPL Research, did a really interesting blog post about the seasonal variation of stock prices. I'll highlight a few things that investors should think about. Plus, I'll put a plug in for our newly designed blog housed at lpl.com under the Research tab. First, you can see from the chart that January seasonals are historically positive, but this first month of the year is just a middle-of-the-road month, ranking 7th of all months over the last 5 years. The returns over the past 10 and 20 years, however, are almost flat, ranking 8th over those periods. Second, in this chart, you'll see, looking at slightly longer seasonal patterns, the January and February period tends to have weaker performance compared to other 2-month return windows, ranking between 9th and 11th of all such 2-month windows over various time horizons. Much of this is due to a weak February, dragging down the 2-month return, with February being the second worst month for stocks, just behind September. So you can see the beginning periods of the year are typically not the strongest months for equities. Third, despite the lackluster seasonal support for the first 2 months of the year, investors could get a nice surprise out of the latest Fed pivot. And it boils down to a few macro trends that put the Fed in a sweet spot. The job market is starting to cool down, and inflation will likely ease further in the coming months. This environment gives the Fed some leeway to prepare markets for upcoming rate cuts. That will certainly be welcome news for markets after an aggressive tightening campaign the last year and a half. Well, that's all for now, but please continue to follow us on social media for up-to-date analysis on the investment landscape.